Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, there's improvement on the jobs front, but the market's reaction to the news was kind of an interesting one. Our panelists expand on that. Editor-at-Large Steve Reitmeister, Research Director Shiraz Mian, and market technician Kevin Matris, all here with me on this edition of the Roundtable. Now, I'm not just talking about any improvement here, folks. I mean, we're talking about a report last Friday, and this is the 7th of November, in case you're following the calendar, that said November job losses were the fewest since the start of the Great Recession. Unemployment rates decline is the biggest in more than 3 years. That, for the market, should have been big news, yet the market traded on both sides of break-even before ending the day just up 22 3/4 points for the day. So what is that telling you, Steve? What is that telling you about what does the market need more news to trade off of?
Well, there's really like a story going on inside of all that. So in other words, there's no one who's doubting that this was a great jobs report. But what we saw is after a robust start to the market is there was a shift of industries. What happened is this is a sign the U.S. economy might be in better shape than some people thought. And the dollar started firming up. And so a lot of stocks that had done very well because of a weak dollar trade, so whether that be gold, commodities, oil, et cetera, people started taking some profits on that. So those are kind of the winners in the market, and the money started shifting around. So really, it was a day of big winners and big losers on the day, and the question is, what kind of follow-through are we going to see on that? Will the dollar continue to firm up? Will this strong dollar trade, will things start flipping in that direction? That's why it was such a crazy day.
But yet, Kevin, this was the news that the street was waiting for, right. This beginning of this healing process on the jobs front. So if what Steve says is true, going forward, is this going to be more of a market of, one stock at a time?
I don't know about that. I mean, it was a great number. This was the second week in a row where we saw claims fall below 500,000. And so that was good. And by the way, the reason why that is so good is because historically speaking, the idea is that once you can get jobless claims in the low 400K area, that is where newly created jobs are in theory supposed to offset newly lost ones. So seeing the unemployment go from 10.2 down to 10%. That wasn't as big of a shocker to me as so many people were making it out to be. And let's also not lose sight of the fact that even though we are at 10%, it was finally saw the decrease. We're still 2 full percentage points above the high level, the 8% that the administration was expecting to see. But I think what happened last week is the report was good, but we've had such a big run-up. It's not out of the question to think that some of these traders with so many gains in their accounts are going to finally start taking some of that money off the table in preparation for the end of the year. But for right now, the report was a good report no matter how you slice it. And but I do think you're going to see more distinctive winners and losers as we move forward.
Shiraz, you saw the reaction to the markets back on Friday. Does that reaction indicate to you that this news was already baked in?
No, it was not. The market, particularly from the Fed's perspective and from the monetary policy perspective, was more looking at the easing and the softer monetary policy stance coming at least a year down the road. And this stronger than expected report forced the market to reassess their outlook. So my sense is that many market participants are now looking at the Fed removing the easy monetary policy stance somewhere in the second half of next year versus the prior outlook, which was more a year out. So, and that's adds to what Steve referred to in the strengthening dollar trade as well. If you have the interest rate outlook for the U.S. Change in terms of being tightened, that's good for dollar, and that good for the entire money flow into the U.S. economy.
You brought up a good point as far as the Fed is concerned. Now, our chief equity strategist on Zacks.com, Dirk Van Dyke, doesn't feel the Fed is going to raise rates for another year. Right. How do you feel about that?
It's going to be a while. A year, that might be too long. I think what we recently saw here whether that be the TARP money getting paid back earlier and actually getting a decent return on that money, whether that be the jobs picture getting better sooner than expected.
Yes.
By the way, did he say this before or after the jobs report?
He said this on the heels of the report.
On the heels. Is that afterwards?
Yes.
Okay, thank you. That's fancy media speak. Okay, so I think it's going to be a good 6 to 9 months because they made it very clear it's going to be a while, and they definitely want to make sure that they avoid the economy slipping backwards. They want to avoid the double-dip recession. They want to avoid deflation for sure,
That's right.
and they'd rather worry about a little bit of inflation. So therefore, keeping the easy money going a year, that might be pushing it.
Where are you at on that, Shiraz? Are you in the camp of second half of next year? Raising?
I would say towards the end of the year. My sense is that there is so much excess capacity both in the labor market as well as in the manufacturing that the Fed being concerned about inflation is not a big worry, at least in my view. So I'm not looking for the Fed thinking of raising rates like, say, first half next year, but something that they would be concerned about communicating to the market and shaping expectations in the later half of next year. And keep in mind, even if we have a number of quarter point raises, say, for example, in the second half of next year, we would still be at extremely low interest rate levels.
I just quickly want to add that we have to remember that the normal Fed funds rate, what is considered like neutral, is like 3.5%.
That's right.
We are a ways off that. Right. So even if they start bringing it up a little bit, okay, it would still be accommodative in the greater scheme of things. It would still be robust for the economy. So we have a long way to go to get to that 3.5 neutral standpoint.
So, Kevin, looking at all of this now in retrospect, to you, is this a clear enough signal that the economy is on the mend?
I think the economy is on the mend. We are going to have to see unemployment continue to move lower in order to see this recovery really take hold, because I know we've said this repeatedly, but since 70% of the GDP is tied to the consumer, you need a healthy consumer to be able to keep this engine going. And part of the requirement for being a healthy consumer is you have to have a job. Going back to last week, though, about all this interest rate stuff, people started saying that, people are reassessing the idea that the Fed is going to increase rates much more sooner than they had forecasted. I personally believe that is unfounded. If you look at Bernanke's previous statements going many months back, his big fear is increasing rates too quickly because he believes those were the mistakes that were created in the past. So I think that the media was looking for a reason to somehow put this 200-point gain or 150-point gain into a 20-point gain at the end of the day. But I think that the jobs numbers portends better things in the economy. I think the economy will continue to grow. But the reason why I also don't believe rates are going to be jacked up too quickly too soon is because Bernanke and company, they have already said they expect the growth to be quite moderate. And with unemployment so high and growth expecting to be moderate, it's going to take a long time to see that 10% drop in any meaningful way. And I don't think rates are going to move until we see at least several point decline in unemployment.
Don't forget also that while we have made a big up move in the stock market since those March lows, there's still a lot of investors out there who have not recovered the bulk of their losses.
Right. Well, if you go from Dow 14,000 and now you're at Dow 10,500, 10,400, there's still obviously a lot of money that's been lost. But here again, are people in better shape than they were at Dow 6,500? Yes.
Right.
Okay, and that's the perspective I think that most people have.
So does that change the scenario for slow going in the market for the year ahead?
I think Kevin shared some of these statistics in the past that after a market bottom, like when there's a tremendous bear market and then the market rebounds, the average 1 year rebound is 55%. Okay, now you go out to 3 years, it's 77%. That means that it's now you're getting just smaller, more reasonable gains in the 2 subsequent years afterwards. Mm-hmm. That is what I think most people are expecting. Actually, some people are expecting to give some of it back this year. I don't know if that's necessarily true, but a 10% gain for the index in 2010 seems quite reasonable. And guess what, folks? That's normal. That's the normal world.
That's right.
Shiraz, a lot of people out there are voicing a concern that This time of year we typically look for a Santa Claus rally in the stock market. This year it may be difficult to pinpoint what is the Santa Claus rally, because there has been a rally ongoing here for a while.
Exactly. I want to get back to one point that Steve raised earlier about the dollar strength versus the extremely crowded weak dollar trade that everybody had been talking about. Mm-hmm. And if this trend remains in place as we have been seeing since Friday, this could make a lot of us reassess a number of stocks and sectors that we had been looking at in this rally. So the commodity groups, more international-centric stocks, money will be coming out of those, and hopefully potentially going into sectors that have been left behind. So we may see new leaders in the market in the coming months and days.
All right, Kevin, I want to give the final word to you. Are you looking at any particular technical resistance level on the S&P?
Let me go to the Dow, because that's the one that I've really been focusing on.
All
but
right.
I do believe that the Dow Jones still has the ability of getting to right around the 11.2 area. I think that is still a reasonable technical target, and if we can not fall apart in that area, I think that we could create a nice base and potentially have a really nice 2010.
All right, latest thoughts from here anyway, as the slow healing process continues in both the markets and the economy. With everyone here at the Roundtable, I'm Terry Ruffalo.